The wheel strategy is safer and easier than any other option trading strategy. In 5 easy steps, I'm going to show you how to use this easy strategy to generate $5,000 a month or more. In the past month, I've made over $100,000 and a lot of it is from the wheel strategy. So take out some notes. This is going to be the most important video you need to watch from start to finish to create safe, passive income from someone with a track record that shows you their actual results with transparency. Liking this video makes me smile and helps me out a lot. So here's a picture of a smiling dog as a present for hitting that like button for me. The wheel strategy is my favorite strategy because it's a system and a process for entering stocks for the right price. You get to pick the price to enter the stock, and you also get to pick the price at which you exit the stock. You are in full control of your risk and your return. The wheel strategy has a lower risk than stock investing because to start, this strategy, you just buy a stock below the current price. Now, how do you do that? You use a put option. You sell a put option, and that right there is how you buy a stock for cheaper than the current value of the market at this time. I'm going to show you the position I have on SPY, QQQ, and how to pick the right strike price of other stocks you may wish to run the wheel strategy on. I completely understand that you're likely in your 30s or 40s or older, and you need safe income. You need safe, passive, consistent income. Despite my age, I also depend on my portfolio income to travel and live a lifestyle on. I've only been to 20 countries in the past year, and that has come from my option trading portfolio. That's why a lower risk, consistent return and income is so attractive to me, and I hope that's also attractive to you. The wheel is perfect for that because you can make a steady $5,000 or more per month. I have a student named Denny who only does the wheel strategy, and he's made $6,500 a month for many months in a row. The biggest benefit is assignment and management is very minimal with the wheel strategy. Now, of course, there's some, so I'm going to go over that. So check this out. Number one, you want to identify a stock that you wouldn't mind owning. This can be any stock that you believe is a good long-term investment to begin running the wheel strategy on. Because after all, this is a slightly bullish strategy and you do want to like the stock that you're running the strategy on. Number two, you want to sell a put option on that stock at a strike price that is below the current market value. So say the stock is at 100, you can sell a 95 put. That means you can buy the stock for 95 instead of 100. This also means that you are agreeing to buy the stock at that strike price if it falls to that level. In exchange for taking on this obligation, you receive a premium payment up front. It enters your account right away. I like picking a put to sell around a 30 delta. I'll go over the best delta shortly, but the main thing is you want to balance collecting high income while not necessarily getting assigned. Getting assigned is fine, but collecting 2% a week for 5 weeks before finally getting assigned is better. There's nothing wrong with assignment though, since you want to own the stock. It just doesn't hurt to collect a bunch of premium and then buy the stock in the near future. Number three, if the stock price remains above the strike price that you pick, the put option will expire worthless and you get to keep the premium that you already got paid. You can then repeat this process by selling another put option at a lower strike.
Alrighty, so let's show you some of my positions and let's go over the wheel strategy and some of the stocks that I'm currently running the wheel strategy on. Currently, you can see I have a Kraft Heinz position. I'm going to click into this right now. I've essentially sold a put option to begin the wheel strategy, and so far it's going very well. I'm up $620 and I have 20 contracts currently open. Kraft Heinz is at $28.50 while my strike price is $28. So it's not really clear if I'm going to get assigned here or not, but what will actually happen is if this position expires, then I'm just going to sell another one at the same strike. Now I want to show you Archer Aviation, ticker symbol ACHR. I've actually been running the wheel strategy here and I have already been assigned. So I want to show you what has happened so far. And I'm going to go down into my history and then explain to you pretty much step by step what has happened with this stock and running the wheel strategy on it. So you can see here, November 25th, I sold a put option. I did not get assigned. I collected 3,000. And then November 27th, I sold another one. And basically this position expired on 12/20. You can see on 12/20 in my community on Discord, basically what happens is on Fridays when options are expiring and I know they're going to expire, I start opening up new positions. So I opened up a 7 sell put, and then on January 6th, I opened up an 8 sell put. You can see how I'm collecting income and I'm not even getting assigned to even really run the wheel strategy, but I'm running the wheel strategy. If I do get assigned, then I'm going to go ahead and sell covered calls. So far I have not gotten assigned. Then I sold some more on January 15th at $8, and then February 10th, and finally I got assigned in April. So you can see here how I'm pretty excited to get assigned. That's a completely, good thing because I've been collecting income and I wanted to, successfully run the wheel strategy, and I got assigned here for $8. And what I ended up doing was I ended up selling covered calls at $8 as well. And now it's okay to go below your cost basis, by the way. So if you need to go below your cost basis to sell covered calls, that's fine, because the whole goal here is to collect safe passive income. And I'm personally happy to acquire shares. So I'm very happy to acquire Archer Aviation for $8 per share. Now, what I'm actually going to do on Archer right now, I'm going to show you a really interesting strategy, which is the wheel strategy, but I'm actually going to sell some put options right now. And my explanation for that is essentially I'm happy to own even more Archer. So I've been assigned. My average cost is $7.21, and that's because I got assigned at $8. But I collected a lot of premium, so my average cost is $7.21. This position is 1.3% of my portfolio, and I have covered calls at 8, which are currently, in the money. And what I'm going to do ahead of earnings is I'm actually going to sell some more put options. This is an interesting strategy. I still pretty much call this the wheel strategy, but it's really called coverage strangle. Okay, it's a coverage strangle strategy. I have sold puts to get in. Now I'm selling covered calls, and now I just want to acquire really more shares. So I'm going to go ahead, sell put. And going into earnings this week, I'm okay selling put options. Actually, let me reconfirm when earnings are, because earnings is very important. So it's in 4 days. 4 days from today will be Friday close, it looks like. So yeah, I'm going to go ahead and trade ACHR options. Going to go sell put. And now I'm going to show you how I'm going to pick the strike price. So you see here, basically an 8.5 put is going for $17. Now, if I go for the following week, it's worth a lot more. And that's because likely earnings is probably Friday after close, because the premiums are just massive next week. But, going for this week, they're just not that much. So what I'm going to do actually is I'm going to sell 7.5 puts. And that's because I'm comfortable selling a lot of these since it's, very much lower than the current price of the stock. I'd be very happy to own more Archer shares at 7.5. I can also sell 8. I can actually click on both and I can actually sell both at the same time. But I'm going to go for 7.5 and I'm going to just go ahead and open 5 more contracts. Nothing crazy. And I'm actually going to go ahead and sell these right now and, collect a little bit of income, but, very, very little small portfolio trade. I'm going to collect about $90 here on this trade. So boom, I just collected $89.79. I sold 5 contracts. And I did this because basically Archer is a red day today. It's coming down, which makes the options more attractive. They have more implied volatility. And just running the wheel strategy, it's good to do it on red days. It really is, because the stock is down, and then selling put options, yeah, you can collect a lot of money and you get a lower price than you would have yesterday, because today it's down and it's cheaper. And by the way, so I have 1.31% of my portfolio in Archer, and it's okay for me to go up to even like 5%. So when I'm running the wheel strategy, I'm trying to basically sell puts and really do get assigned. Now, if I don't get assigned, that's fine. But if I do get assigned, it's really just a plus. And I'm fulfilling my number one rule. My number one rule is I need to want to own the stock that I'm running the wheel strategy on.
Let's talk about the number 4th thing that you have to do to run the wheel strategy successfully. If the stock price falls below the strike price and the put option is exercised, you will be required to buy the stock at that strike price. However, since you received a premium payment up front, your effective purchase price is actually lower than the strike price. You can then hold on to the stock as a long-term investment or sell a covered call option to generate additional income. The cool part here is that I've seen investors collect $2 on a stock that's $100 every single week for 10 weeks. By the time they actually get assigned at, say, $100 per share, they have already collected $20 or $2,000 worth of premium consistently over the last 10 weeks. So in theory, their average price is not actually 100. They collected so much premium that their average price is actually 80 because they've collected 20. Now, step number 5, the last step, is to repeat the process by selling another put option at a lower strike price, or if you do get assigned, you are just selling covered call options on that stock that you now own. Now, let's get into the small details and tricks that I have for maximizing your return while minimizing your risk. Keep in mind, I've seen other trading courses and their paid programs don't even compare to my free content. So if you appreciate this, please leave a like on this video and consider subscribing, because my free stuff beats everyone else's paid stuff. I'm positive. I also do have a free newsletter where I send stocks that I am buying, including what stocks I'm running the wheel strategy on. So that's in the description below. So check it out. I'm going to jump into my portfolio. As always, I'm very transparent. I'm going to show you the current example and current positions that I have that I am running the wheel strategy on. And I specifically want to go over an example that you can also copy, or at least understand why I am running the wheel strategy on certain stocks while I'm not doing that on other stocks. So keep in mind, this is the most important part. The goal of the wheel strategy is to collect premium, not to get assigned a stock right away. And that's why you'll see me in the example using options that are significantly out of the money. That's also why I like picking a delta to sell a put option between 20 and 30. If you go below 20, that's fine, but you will suffer in getting insignificant returns in excess of 20% a year. But if you go above 40 delta, well, that's basically going to increase your assignment risk to almost a coin flip 50-50. While being ready and able to take the stock is part of the plan, being assigned is the end of selling puts and getting a much lower price on the stock, and it's the beginning of generating income on the stock by selling covered calls. Nothing wrong with that, but again, it is nice to make 2% a week and keep doing that, rinsing and repeating that process for 5 to 10 to even 15 weeks if you pick a low delta. If you sold a cash secured put one time and you were assigned, you are either doing something wrong or you're terribly unlucky by picking a stock that has tanked. Cash secured put just means that you have the cash to buy the shares when you are assigned. As a coach and trader myself, I'd never really recommend naked option selling. I'm all about consistent safe income, not gambling and not unlimited risk. So when I am selling puts, I'm doing so at a 30 delta, maybe even less than that, and I am always cash secured. So if I sell a $10 strike put option, I do have the $1,000 to buy 100 shares of that put option. So selling short or cash secured puts indicates that you have the cash or the margin, I do use margin from time to time, to buy the stock if it is assigned. Be aware of any upcoming earnings reports or other events that could cause a huge movement in the stock. It is best to close or have the put expire prior to that event. However, I do sometimes sell puts before earnings, and I've done that very successfully on Tesla. I've made a lot of money on Tesla because the options will usually be very expensive, and that's not a bad thing if you're an options seller. The market knows that there is an earnings event and the implied volatility will spike for that earnings event. And this spike translates into larger premiums on the option itself. So again, it is better to avoid, but it does depend on a case-by-case basis if you want to sell a put that does include the earnings event. This is also why I run a Discord where I trade live, because it really depends. Sometimes I want to trade into earnings and sometimes I don't, based on many different factors. Now, when selling a put on the selected stock, here is the game plan as I'm going to show you the example. 7 days to 45 days is going to be the days to expiration. This offers a good premium, and at the same time, these options are decaying very fast, so you're collecting a good amount per day based on the theta decay of that option. So people ask me all the time, is it better to go 1 week or is it better to go 1 month? And I always tell people the same thing. It's very similar to real estate properties. If you can have a property that cash flows, whether you're collecting $1,000 a week or $4,000 a month, they are essentially the same thing. There is no point of going to your tenant's house and knocking on his door and saying, hey, can I get my $1,000 this week? Just let that cash flow property do its thing and collect your $4,000 per month. Options are very similar to that. I like doing monthly trading because it's a lot less work, but weekly trading is also very fun. And I will be honest, there's a slightly bigger profit on a weekly trade. So for example, it might be $1,050 per week instead of $4,000 per month, because there is a little bit more time decay on those options that are expiring in 1 week. And there's also usually a little bit more implied volatility in the short term. But regardless whether I'm going 1 week or 1 month, I'm always going for a 70% probability of out of the money, or essentially around a 30 delta or lower. If I can get a 25 delta and still get paid handsomely, I'm very happy with that because that means I'm going to win 75% of the time, and 1 out of 4 times I will get assigned. Calculating the number of contracts you want to open based on your account size is also very important. I don't want to open up $15,000 worth of Oatly stock, which is a small cap company that I own, as that would be slightly risky as a percentage of my portfolio. While I wouldn't really care about opening a $250,000 position on SPY since it's a large cap diversified ETF. So you want to be careful when you're running the wheel strategy. Of course, if you have a smaller portfolio, it's good to go for cheaper stocks. But be aware that you don't want to just pick cheap stocks. You want to have a combination of different stocks that you're running the strategy on, as it's never wise to put all of your eggs in one basket. Now, the last thing before I jump into an example is you want to look at closing this position. So if you've made 50% of the position in 3 days and your position is expiring in 4 weeks, then you probably want to close this position. That's because ideally you are making money over a 4-week period. But if you've already made all of your money in 3 days, there is no reason to keep holding this position until expiration unless you really, really want to get assigned. What I would do in this case scenario is I would just close the position, take my 50% gain, and then reinvest the money into another position. With all these tricks and secrets being said, now let's go over an example in my portfolio of running the wheel strategy on SPY, QQQ, and other positions that I'm looking to open up in the near future.
Alrighty, so now I want to open up a position on QQQ and SPY. So I'm going to go to QQQ right now, and I'm going to run the wheel strategy and begin the wheel strategy using QQQ. The reason why Triple Q is so good is because it's already diversified, has technology, has consumer cyclicals here, communications, defensive, industrials, everything is already in here for the most part, mostly tech focused because SPY is more broad, whereas QQQ is a bit more on the tech heavy side. But yeah, essentially I'm going to be selling a put option right now and beginning the wheel strategy. And look, you can really make a full-time income just doing the wheel strategy on QQQ and SPY. And I know a lot of people that, they want retirement income that's safe and passive, and you can absolutely scale from $10,000, $20,000 a month plus, especially if you have a bigger portfolio. You can just, really just do QQQ and SPY. So I'm going to go for May 16. I'm going to do a small position here just to show you as an example, but also, eat my own cooking here. I'm going to show you myself. I'm going to do this for myself. Now, I do have other single stocks that I do prefer because they have higher implied volatility. But yeah, QQQ, yeah, it's really great as well. So I'm just going to scroll down here. I'm going to go for 470. 20 delta is pretty good. Very good bid-ask spread. That's a very, very good bid-ask spread. Very good volume. So yeah, I'm going to go ahead. I'm just going to sell one contract here. Nothing crazy. I just want to show you that this is something that I would be doing for myself. However, my capital is tied up. I made a lot of trades actually today in my Discord community. Ended up making a few trades, and yeah, I'm pretty cash poor at the moment. So I'm actually doing this on margin right now. So I didn't get filled here, as you can see, and that's because although the bid-ask spread is tight, I'm going to have to, oh, nope, I got filled. Perfect. I was going to just replace that order. So I did get filled here. I collected $280. So that's great. And now I'm going to do SPY. So I'm going to go for SPY right now, and pretty much same thing. You want to go for a lower delta. When you're running the wheel strategy, you want to go lower delta because, again, it's really good to just collect consistent income, and essentially you collect income many times and then eventually get assigned, and that's good. You want to get assigned, and then you want to do covered calls, and you want to basically collect income on the covered calls side of things. So yeah, I'm going to go to trade SPY options. You can also go shorter term. So for example, today is May 5th. I can go for May 9th. So I can go for, a weekly expiration. I can also go for really, really short-term expirations. I probably can't do May 5th, same day. You can trade contracts until 3:30. Okay, so I actually can do this. So look, you can run the wheel strategy very, very short-term, although I don't recommend it. Basically, I want you to understand that you can be very flexible. You can go for weekly income, monthly income. I don't really recommend short-term here because although, if I sell a put option here, I will collect $10 and it's going to expire today within 30, 40 minutes from now. It's still kind of not ideal because you will end up, sometimes getting assigned. You don't want to have to really deal with that. But still, it's much better than just buying the stock outright. Running the wheel strategy is a phenomenal way to just enter stocks for cheaper. Yeah, just cheaper than they're trading at. So I am going to go for May 9th, which is going to be a Friday expiration. And I am going to go look for a 20 delta. That's a 22 delta. If I go to 552, that is a 17 delta. 553 here, yeah, 20 delta, so that's good. So yeah, I'm going to go ahead and sell one of these. And this is a pretty big boy trade. It's a lot of capital at risk, right, potentially. And yeah, that's okay because, I want to own SPY anyways. That's a good ETF to have. And there we go. I sold one contract, collected $159. This would be more of a big account trade, but there's a lot of flexibility with running the wheel strategy. You can run it on cheaper stocks. And I actually go over the wheel strategy in great detail in my ebook, which you can find in the description. And yeah, if you have a bigger portfolio, I can also help you one-on-one, give you some coaching, and actually sit down with you one-on-one over a Zoom call and basically just allocate some of your capital with you and show you what I would do if I were in your shoes. So yeah, you're welcome to check out the two links in my description, one for the ebook and one for my coaching. And I hope you enjoyed this video. Make sure to subscribe, and I'll see you in the next one.